Well, welcome everyone to Financial Markets Insights for a special In Conversation With episode. We're here to talk about all things liquidity with Managing Director and Head of Market Structure at TD Cowen, James Baugh. James, good morning. How are you?
Yeah, I'm very good, thank you.
Great. Well, let's get straight into it. Firstly, congratulations are in order. You won the Sell-Side Market Structure Excellence Award recently at the Trades Leaders in Trading Awards, which is obviously a great achievement for the team. Perhaps you could share a little bit about your background, but also how that experience helped to shape the content and the commentary that you're able to provide your clients.
Yeah, no, absolutely. Well, first of all, it was a great recognition for team TD Cowen. We excuse me, we have to compete with much larger banks and brokers, and there's some great market structure teams out there. So yeah, we were super pleased with the award. Um, I mean, in terms of my kind of background, I've been very lucky in respect to my career. I spent a large chunk of my growing up at London Stock Exchange, where I was, I suppose, latterly in the last few years, head of sales for the secondary market, the trading business there, and it just gave me some really good experiences working not only with the member firms, the sell side, but also the buy side, just understanding what their needs are, what their requirements are in respect to evolving market structure, particularly post MiFID one, removal of the concentration rule, the introduction of competition, fragmentation. It was just the right time, the right place to really be in the thick of things. And the London Stock Exchange, great platform for launching many careers in the industry, and I think that's also helped me along the way, just because in the role that I do, certainly in market structure, it's not always about what you know. It's a lot to do with who you know, who you can reach out to ask those questions, and just to get a good sense of what's happening around you. And then I went to Citibank for nearly 5 years to do a very kind of specific market structure role in the run up to MiFID two. Again, fantastic experience in just getting a business ready for all of those regulatory changes as we I suppose, rolled into to MiFID two, um, and now doing a not too dissimilar role with the folks at TD Cowen, and again, it's a continually evolving uh, industry. We've now had to take into consideration all the impacts of Brexit, um, and obviously we can dig into some of that as we go. But yeah, I think that I'm quite fatalistic in my outlook on life and my career, and sometimes it's hard to kind of rationalize why you do what you do and how you've got here. But actually, it's been a fairly obvious career path to where I am now, and as I say, I've been super lucky.
Yeah, as you say, the LSE has been a great place to cut your teeth for many people actually in the industry. And as you said, it's been a solid launch platform for a lot of careers. So, thinking about TD Cowen more, what is it about the firm and your approach that enables the industry to really give you this level of recognition in what is a relatively short period of time since the business launched?
Yeah, no, I was kind of thinking this through a little bit, and I suppose first and foremost, TD Cowen give me that platform to be able to engage with our clients, to afford some opinions around the market structure dynamics, the market structure changes. And as I said earlier, my time at LSE, that more kind of commercial role, definitely I think gave me a slightly different outlook when it comes to market structure, not just thinking about those um, regulatory documents that can be many hundreds of pages, not just doing the copy and paste and firing it out to a client to say, these are the changes, but thinking much more about how that impacts, their business. What do they care about? Um, and it's been able to extract the salient points. And I think in some organisations to afford that opinion, and you can be somewhat kind of constrained. And I've been very lucky that TD Cowen have recognised the importance of being able to engage with those clients and have those opinions. Um, and I think perhaps much more importantly than that, when I was first talking to then Cowen before we were acquired by Toronto Dominion Bank, what was evident in those initial early conversations is that they very much put market structure at the center of their business, particularly their their low touch business, whether that's in respect to product development, the liquidity strategy, and as many folks will know, this is a model that has been super successful in the US under the guidance of Jenny Hadiaris, who heads up market structure for the US. And now we're lucky enough to have a colleague up in Toronto, in Canada, Peter Haynes, who does a very similar role. So I think that having that function at the center of your business, driving you know everything that you consider to be in respect to, as I say, um, building out that platform, I think really sets us apart from others, and what keeps me going day in day out, and ultimately why I joined Cowen, a few years back.
Yeah, I think that's interesting. And we can dig a bit more into the model later, but certainly that ability to be completely open in your interaction with customers, to talk about the consequences of changes to market structure, the unintended consequences in an unfettered way, that must be really refreshing for you.
Yeah, and also, I think for me, what was really interesting when I joined Cowen was very much in growth mode, very much, I suppose, at the start of that journey, i- in in part following, I suppose. Um, Deutsche Bank stepping away from their equity business, and a bunch of guys and girls moving from Deutsche Bank to Cowen, and everybody was super excited, super stoked about that opportunity to be able to build a business and entering into that environment with those folks that have got some great long-standing relationships. Um, and tying that all together with market structure, it was just a perfect opportunity, and I think that has really lent itself to hopefully some of that recognition, and how we've been able to build on that in what is a relatively short period of time.
So, talking about the collegiate relationship with customers, at the end of last year, you were featured in an industry paper along with Simon Stewart from Capital Group and Evan Canwell of T. Rowe Price. And you were looking at the extremely challenging landscape for liquidity in Europe. Could you share some of your thoughts around the background to the current situation?
Yeah, I mean, look, I think we're not immune to the macro conditions, and I think that talking to folks in the industry, this is really very much in Europe. And when I talk about Europe, I'm talking clearly about the UK and Swiss. Um, there's a value versus growth proposition that's playing out here, and I think that from an equities market structure perspective, it could be very easy to perhaps dive too much into the detail and maybe question the market structure itself, as to why we are where we are today, particularly in respect to those liquidity challenges. I don't think that the two are necessarily independent of each other. Um, and there's no doubt that there are, let's say, regulatory challenges, constraints that do perhaps uh, you know make the European equity markets slightly more opaque than perhaps others, and dissuade some of that inflow into Europe. Um, but I think it would be a little bit too easy just to point the finger and say, well, um, you know, Brexit has meant that we're now in a situation of um, divergent regulatory frameworks that are in essence um, resulting in this kind of liquidity squeeze that we see today. I just don't think that's the case. I think it's bestowed upon us all to think about that and to think about how do we make the secondary markets as attractive as possible in the UK, in Europe, at a time when we are facing these challenges, and we are having to consider how we execute business, particularly when we see that liquidity squeeze.
I think partially, if you think about sort of the direction from regulators, politicians, and the thought process around MiFID II, etc., it is a matter of there's consequences. And there's also unintended consequences, and things have sort of played out maybe differently to what they thought they might ahead of those new regulations coming in. So, thinking about that, what has been the practical effects of these changes? Has the situation, continually evolved since the piece you did with the guys from T Rowe and Capital when it was initially written? Because this is an ever evolving situation.
Yeah, I mean, I think since we did the piece, I think it's very much much of the same, and maybe just to kind of you know uh, set the scene a little bit. I think we've seen that liquidity squeeze, particularly intraday liquidity, and consequentially, and perhaps unsurprisingly, we now see more business bookended to the close, for example. Um, and I think when I kind of ran the numbers for January, the close had come off a little bit when looking at the primary auctions, but we're still talking 30% of the day's kind of volume is now executed there, and we know on index-free balance days that can be upwards of 50% plus. So
It
um,
wasn't many years ago, it was about 8%.
yeah, and again, I think it's just the way that the market's evolved. You don't want to necessarily be um, exposing yourself in the middle of the day if there's no liquidity to be had. Much rather to coalesce around that liquidity event, albeit at the end of the day. Um, and unsurprisingly, again, I suppose that we see more business executed into the periodic auctions. January, I think, was a record month for the periodics. Client natural liquidity events that like-minded institutional flow can execute intraday, not necessarily having to wait for the close. Um, but also, the one thing that we highlighted in the paper is just the pressure, the margin pressure, the cost pressures, particularly on the sell side, which has um, led to much more internalization of business. And alongside that, continued growth in bilateral liquidity provision. So that's liquidity providers direct to buy side, as well as what we've also seen, and that is retail flow being consumed by some of those liquidity providers, those market makers as well. Um, and I suppose it's that juxtaposition where um, the market makers, the bank internalizers, are perhaps plugging that gap, that liquidity shortfall. But that liquidity itself is not uniform. It's not accessible to all, and therefore it somewhat compounds. The lack of intraday liquidity. So it's a very challenging environment that we find ourselves in. But the cliche being that where we see those challenges, there's very much opportunities, particularly for firms like ourselves to differentiate how we access liquidity, and we provide um, execution services to our clients.
You obviously talk to customers day in and day out. How challenging really is this for the buy side at the moment? And has the sell side reacted? I think we traditionally think of the sell side as big banks and brokers, but increasingly, as you say, those market makers have direct relationships with the buy sides now. So are they almost a quasi sell side in their own right?
Well, yeah, yes and no. I think from what I understand is that they're not providing a sell side service per se. It very much is a hands off price feed. that you can sort of take or leave. But I think in answer to the question, how has the sort of the buy side reacted or needed to react? It'd be simple to say, well, that's the domain of the sell side. They don't necessarily need to think too long and hard about it, but that's very much not the case. And as you say, if if there are opportunities to interact directly with liquidity opportunities, then I think um, very much so what we're finding now is that, and as I mentioned before, liquidity is not uniform. It's not perhaps as once might have considered it as a commoditized thing. And I think the buy side have to be able to assess the differences in service offering, the differences in quality and the performance that their sell side partners, their brokers, their liquidity providers are giving them. And that means, and as I think was highlighted in the paper, this is not just about the sell side understanding the liquidity dynamics. The buy side themselves have to be up to speed on how things are evolving around them. They have to have the smarts in place, that TCA, that analysis, to be able to, differentiate between those service offerings. Which in itself is I think is great, right? It's a positive thing because it keeps us all sharp, it keeps us competitive, and it means that ultimately the buy side should be getting an even better service.
Should be.
Yeah.
So all this has, I'm sure, changed the relationship between investors and the sell side. But does this change potentially depend on the type of sell side model a firm deploys? Is this different between, how different banks or brokers actually operate?
Yeah, I think so. I mean, I look to my experience, and as I mentioned, um, very much I believe, and I still believe that this industry, and particularly in the role that we play, relationship is and remains key. And I think that is super important and has been very, very helpful in developing and growing our business. And those partnerships, um, I think, also help in um, you know very much understanding the nuances of the market. So sharing that information between buy side, sell side, um, and being able to understand what our clients, what their objectives are, what outcomes are they looking for us to achieve, to provide. So yeah, look, I think in that sense, um, we as sell side brokers, banks, we're all looking to compete, to differentiate with one another. Um, I think that there is definitely an element, particularly I think on the low touch side, given what we've discussed, given the complexities, given the liquidity dynamics, um, understanding where those liquidity opportunities are. And this isn't necessarily about accessing all liquidity all of the time. This is understanding what the right liquidity is to interact with at the right time. I think that we have evolved our low touch business to be a little bit more, mid touch. And if that sets us apart from others, that's great. But I would hope that our peers are all looking to do similar, and I think again that's benefiting the buy side. From my own experience, the proximity to our high touch colleagues and thinking about our clients as how do I say it? As a single thing, as a single entity, rather than operating within that more siloed construct, which I've experienced in much larger organisations. I think that certainly has helped, and I think the clients see us as one thing, and they know that they can engage either with myself or others, and know that they're engaging with TD Cowen. It's not, as I say, one desk, scrapping for business, and perhaps looking purely to drive a high touch relationship. For us, that's not what we're about. We know that we can grow our business by engaging across the floor. Um, and again, I'm sure others are trying to do similar, but I just think that right now, that sort of collegiate, using your phrase, relationship across the floor certainly sets us apart. I feel certainly day to day.
It certainly sounds like openness and dialogue with customers and that collegiate approach seems to be key to an optimal outcome for both parties. And maybe it's, a return to a more traditional style of relationship.
I think you're probably right. I guess over my career, it's there's always been this sense that this is a business that can be automated, electronified, and I think to a certain extent that's absolutely true. And not none more so than building out a low touch business. But ultimately, it comes down to the complex nature of how we kind of navigate those liquidity opportunities, as I said. And, um, that engagement, those open dialogues with clients and customers. Means that you're building a platform, a service that they need, that meets their requirements, and without that, you know, mid-touch relationship day to day, again, very lucky with the electronic stack that's been built around us, on the basis that we can configure the variables, the algos. If not, you know, hour to hour, we can certainly do this overnight. And for us, that again sets us apart from others that unfortunately are a bit hamstrung by some of the processes and the the resource constraints, meaning that this is a quarterly release, whereas we can do this a little bit quicker. So um, yeah, I think if it's a return to more traditional relationships, it's an interesting way to put it, because absolutely this has got more technical, more quantity, but underlying all of that has got to be those partnerships, those open relationships with clients.
Yeah, I think you're absolutely right. And I suppose that ability to have that open dialogue, but as you say, with the tech stack, to be able to react so quickly to changes and opportunities that arise through that dialogue is really very effective. So, moving slightly on from that, there's been a lot of talk about European consolidated tape. There's been attempts before. What are your thoughts on the latest version? Is it something that would go some way to solving the challenges we've been discussing?
Yeah, I don't think the consolidated tape is a silver bullet for sure, and it's taken many years to get to this point. And keep in mind, we're still waiting for the finer details of the direction the UK is going here. But yeah, we've got a sense of um, what Europe is thinking, and where that's going. And only recently, I think a week or two back, the European Parliament sort of ratified the proposals, which were put forward all the way back in June last year. Um, and the fact it's taken from June to January, to get these ratified, gives you a sense of how slow these procedures can be. And I'm sure, and I'm aware that there's going to be various consultations and discussions kicking off in fairly short order. But we're probably talking now for Europe and a consolidated tape, maybe 2026, as I understand it right now. Clearly, that may change.
Not a quick process.
Certainly not a quick process, and there may well be differences between what we end up with in Europe versus the UK. So I think we all have to kind of collectively get behind it and be positive. It's not, as I say, going to give us everything, us being collectively buy side, sell side, what we would like in regards to a full depth pre-trade tape in Europe. As I say, UK possibly leaning a little bit more towards a post-trade tape, but we'll have to see. Regardless, um, what we kind of said at the outset of this conversation, perhaps some of that opacity, some of the challenges that we face in respect to the way business is reported here in Europe. Um, the consolidated tape has got to help with that. It's got to provide more transparency, and we can argue, as I say, the benefits or otherwise. But ultimately, um, I think it's got to be a positive. And one of the other things that I do talk to folks about is that in Europe, and you mentioned some of those unintended consequences of regulation, but in Europe, um, we work to this sort of reference price model for dark trading, where those platforms that work under that reference price waiver essentially have to reference the primary bid offer spread, so the primary market price, and that in its sense has created a fairly obvious latency arbitrage between those dark venues and the primary market that no doubt folks are taking advantage of, and we in fact we saw that with the data center migration, the Euronext data center migration to Bergamo from Basildon a couple of summers back. So the way I kind of think about the consolidated tape is much more about getting away from relying on one reference price and thinking about markets as a consolidated view, and I think that can only be healthy going forward when we think about some of the other challenges we face, whether that be market outages where the primary reference is not available because the market is down, so everybody has to kind of put their feet up. And again, you could argue that that doesn't necessarily have to take place even today. But if we can kind of just break the shackles a little bit here and move away from that single view, I just think that's a much more healthy environment for us all. And I think that discussion, that debate around the consolidated tape helps with that. And again, I'm not suggesting that either the sell side are going to be fueling their algos with a consolidated tape, just thinking about the latency implications there, and nor are those venues going to consume a consolidated tape. But to consume those individual feeds and to create that consolidated view of the market, I think, as I say, just puts us in a much better position.
I think, as you say, talking about Europe versus UK, pre-tape versus a post-trade tape, that obviously opens up all sorts of consequences if you were to start using those more within your automated trading decision making. So it'll be interesting to see how the two go forward.
Yeah, and there's going to be some questions asked around duplication of business between Europe and UK in certain securities, dual listed names that are going to complicate the picture, and no doubt there'll be questions raised as to the validity of the consolidated tape and the benefits thereof, um, whether it's the buy side looking at a consolidated view simply to measure their portfolios, whether it's giving retail investors a greater view transparency of the market. Regardless of those doubts, I think that it's bestowed upon all of us to get behind whatever or version of consolidated tape we end up with, and consider this as a step in the right direction, and not necessarily the end state.
Yeah, and as you say, any greater transparency should be, I think, warmly embraced.
Absolutely.
So, where do you think we go from here then? We've kicked around quite a few ideas and thoughts here. Is there anything else you'd like to share?
Well, I think the great thing about um, this job and market structure is that it is ever changing, ever evolving. And I do joke with my colleagues and clients that I live in a constant state of paranoia that I'm going to kind of miss something. And touch wood, I'm just about being on top of things. But yeah, look, going forward, very aware that there are new initiatives at play in the market, new liquidity opportunities. We've got a couple of the primary markets that are pushing out their own dark books this year. All of these for us, you know, essentially provide opportunities for us to engage with the market, engage with our clients, and think about how we do develop our own platform and um, in order to take advantage of these changes.
Well, thank you, James. It's been a great conversation today. So thanks again, and congratulations on the award win. We'd obviously love to have you back later in the year or as things evolve further to be able to continue the discussion because, as you say, this is an ever evolving space.
Yeah, no, absolutely love to. It's always good to air some thoughts, and yeah, I look forward to people's feedback as well. Thank you.
Brilliant. Thanks very much, James, and look forward to catching up with you soon.